Good afternoon, everyone. My name is Catalina, and welcome to our webinar on financial opportunities in the CARES Act. We want to thank you all for being with us this afternoon. We know that your time is very valuable, and our aim today is to help bring some clarity around what are some financial planning moves that you could do during this time. I can tell you, as being someone that has experienced a crisis not that long ago, when I have a plan or when I put my plan into play, it certainly helped reduce my own personal anxiety. So I am hoping that this will create that for you as well, help reduce any anxiety you may have around any financial planning moves, because our goal here today is to help point some opportunities out. I am here with my colleague Yesenia.
Hi,
She's also
everyone.
We are in our new normal, everyone, as I'm sure you are too. We are working remotely, and so this is the first time that we do a webinar outside of our office. We have new colleagues with us, new office mates. Here you see Scrappy. This is my dog, and some of you may have heard me talk about him. He is my new barking friend that I had to kick out of the office for this special webinar. What about you, Jasenia?
Well, as everyone knows, I'm Yesenia, and I have a little corgi, Daisy. She's my new coworker, and she's generally pretty quiet. Don't know that she's around. She's very excited about this webinar, though, and she wants to join in. So I'm going to apologize in advance if you hear any noises from my colleague. She's just so excited because she knows how excited I am to be talking to you guys about everything that's going on.
Very good.
All right, so to get started, here's our agenda of items that we're going to be covering today. We're going to go over some of the main aspects of the CARES Act. It includes both business and individual stimulus packages, but we're going to focus mainly on the individual aspects of the CARES Act. Just so you know, we will host a separate webinar to dive more into the business stimulus for some of our business owners, but today we're going to focus on what you can do as an individual. Some of these opportunities can be implemented by yourself, or they should be done with the guidance of your advisor. So we'll go over what some of those are, and then we'll wrap up with a Q&A to make sure that you are equipped with as much information as possible as it relates to the changes that we're experiencing today, because I do know that even after we go through this, there may still be some questions. So we do encourage you, as you have questions, to start typing them in under the chat. We'll be able to receive your questions and then answer them at the end. All right, so what is the CARES Act? I know that we've been hearing a lot about it. So what it is a stimulus package that was signed into law on March 27th through nearly unanimous support from Congress. The stimulus package is the largest that's ever been enacted, and the total cost is estimated at over $2 trillion. And this is just today. They're actually looking to expand it a little bit more for small businesses, so this could be even bigger. This is an overall picture here on the slide of what it offers. There's funds allocated for individuals and businesses to keep people working and with sufficient funds to meet their necessary expenses. That really is the main objective, of this CARE Act. And you can see here on the chart that the majority of funds have been allocated to individual taxpayers and businesses. Instead of listing each provision of the CARE Act here, we're going to instead dig deeper into some of the specific aspects, such as the stimulus checks and tax changes, which I know those are the ones that most people are excited about, and also discuss how they present planning opportunities to our financial planning clients. All right, so let's dive right in. And I'm going to start with taxes because I know that's top of mind for many of you. During a normal year, most of us would be scrambling now to get tax returns filed by April 15th, but now most of us are scrambling to try and find some time alone outside while adhering to social distancing, adjusting to our new normal. But in order to provide relief to Americans, several deadlines have been extended. For 2019, the individual income tax return deadline has been extended to July 15th, along with several other tax forms. So even if you file before April 15th, you can delay paying any tax due until July 15th. So we recommend if you do owe to the IRS for 2019, just wait on making that payment. You don't have to do anything to qualify this. It's an automatic extension for everyone. So if you do owe, just wait and pay as late as you are able to. Even the 2020 Q1 estimated tax payment has been extended to July 15th. However, note that the Q2 estimated tax payment, as of today, is still due on June 15th. We might receive additional guidance regarding this payment because, yes, it is a little bizarre, it's a little funky, but the Q2 estimated tax payment, as it stands today, is due before the Q1. So that's just something to note if you're making estimated tax payments. Additionally, you're going to have extra time to make your 2019 contributions. Even if you don't have cash flow right now to make these contributions, keep this in mind as we approach July 15th. Also keep in mind that these contributions don't necessarily have to come from cash flow. I know that many right now are worried about cash flow, don't want to necessarily take from savings to put into these accounts. But if you do have a taxable account, you may want to consider funding these IRAs, Roth IRAs, HSA, solo 401k from a taxable account. So in essence, you're just moving funds from one pocket to another. So we do encourage you to work with your advisor to determine if this is a good option for you this year.
Yeah, and one of the other provisions that has really impacted our clients is the required minimum distributions and what they can do about this, Jasenia. Something that we really appreciate is that they don't have to take that required minimum distribution in 2020. And the reason for this is because markets have changed and the asset value is likely much lower this year than what it was on December 31st, 2019. So they're extending this and saying, okay, you don't have to take your RMD in 2020, but you do need to resume this in 2021. Now, some of you may have already taken your required minimum distribution. If you have taken it, but you don't need the funds, let's talk about rolling it back into your account. That is a possibility for you at this time. So it's a good change in the law to make it more strategic for you from a tax perspective as well. We also have some clients that like to give what are called QCDs or qualified charitable distributions. The law changed before in that it extended the age to 72 to begin taking those RMDs, but you can begin taking them at age 70 and a half. Now, if this is something that's very near and dear to your heart to give to your specific charities out of your IRA, let's talk about that. Let's make sure that this is a good strategic move for you at this time. We don't want to discourage you from doing that because research does show that it impacts your health positively to give to charity. But we can talk about that because you might want to put them on hold for a little bit. We also want to revisit that required minimum distribution because some of our clients do use these funds to offset estimated tax payments. So if you just needed for that perspective to pay those estimated tax payments, then we could just take what we need to offset that expense and just keep the remainder of the funds inside of your IRA. This is on a case-by-case basis, so make sure that we have that conversation before moving forward with RMDs. And if you have an outside CPA, this is also something really important to discuss with them.
Kat, thank you so much for clarifying that. And also, I love what you just said, that all the pointers that we're going through with the changes and opportunities are on a case-by-case basis. So make sure that you're not looking at this in just a silo, all because we mentioned it. It may or may not be appropriate for you. So we do encourage you to speak with us or your CPA to make sure that they're appropriate. Another opportunity that's available due to the CARES Act has been the expanded charitable donation deduction. So what that means is that those folks who do not itemize, so they generally don't get a benefit from donating, can actually get a tax benefit for donating up to $300 to charity. And this was expanded as an incentive for people to contribute to those charities who right now are working very hard to provide services to those who need it most during these difficult times. And of course, people are feeling this, charities are feeling this as well. So as much as they want to be able to help those most impacted, they do require charitable donations. So this is a way of incentivizing and making sure that you get a benefit if you do choose to donate. Also, something to note is that they have increased the adjusted gross income limit on cash donations. So what that means is, let's say you are itemizing. Typically, you could only get a benefit for up to 60% of your adjusted gross income. So for example, let's say you had $100,000 last year of AGI, adjusted gross income, and you donated 70,000, you would have been limited to 60,000, to that 60%. So what they've done is expand it so you can get a greater benefit of donating more. So that's a change that's also been implemented for 2020. Something to note is that it's really an either or situation. You can either get the $300 benefit if you're not itemizing, or if you are itemizing, you can get a benefit for more charity. So you can't claim both, it's either or, depending on whether or not you itemize. And then another tax move that could be considered are Roth conversions. So as a reminder, a Roth conversion is when you transfer funds from a traditional IRA or 401k to a Roth. So depending on what your income looks like, this year may present an opportunity to turn lemons into lemonade. So let's say you have significantly less income due to reduced work, or maybe you were furloughed. As unfortunate as this may be, we really do have an opportunity due to the lower income. And you may want to consider taking advantage of lower tax brackets and accelerate income by doing these Roth conversions. So generally speaking, the decision on whether to do a Roth conversion or not really depends on your tax rate today versus your tax rate in the future. So perhaps you're in the lowest tax rate you've seen in years and you don't think you'll ever see this tax rate again, then this may be a good year to take advantage of these Roth conversions. Another opportunity in context with Roth conversions is the timing of these Roth conversions. So the fact right now that the market is quite volatile, it is making Roth conversions look more attractive, because what you're doing is transferring dollars from a tax-deferred account to a tax-free account during a market pullback. Now, we don't know when, but we do know that markets will recover at some point. And if you do those Roth conversions today, you're really buying into the market when it's low, and the recovery is going to take place in a Roth, which is a tax-free account. So this is something that, yes, it's tax planning, it's investment management, it's really tying in all of these aspects of financial planning together. And some people might be a little nervous about doing a Roth conversion all at once. And the good news is that you don't have to do it all at once. You can actually do a strategy called Roth conversion cost averaging. Now, this is very similar to dollar cost averaging. I'm sure a lot more people have heard about that, where they start putting little by little into the portfolio, such as your 401k every 2 weeks. Maybe you put into a portfolio once a month to try and buy at different price points. You can do the same thing with Roth conversions. Just take little by little over maybe a few weeks, maybe a few months, and do those Roth conversions at different price points to really take advantage of the market volatility. And a question that we get sometimes is, do I need a traditional IRA to do this? And the question is no. Some folks with 401k plans might have the opportunity to do this within their 401k. So not all plans allow this, but if they do, you can convert pre-tax dollars in your 401k to Roth within the 401k. So we do encourage you to reach out to your HR or look at your plan documents to see if this is available to you. But there's a lot of different options here that have been opened up due to the circumstances. So we do encourage you to review these moves, maybe see if they make sense for you this year. And please reach out to us or your CPA so we can go over these. And all right, the next big question we've been getting, unemployment. So even if you haven't been impacted by a job elimination, maybe you're laid off or reduced, even if you haven't been impacted in this way, I don't think it would be a stretch to say that most of us know someone who has been impacted by this. So many people, either in the cruise industry, in the restaurants, in entertainment, a lot of these people have been impacted, or they just don't have the ability to work from home. Um, so unemployment is something that they may be having to look at. Unemployment has been expanded in the CARES Act to provide a safety net to all of those Americans. So really what's been unexpected. No one saw this coming. It wasn't something that happened in the economy. This is a health crisis they're all dealing with. So the CARES Act did expand it to help people through this challenging time. So with the average unemployment check provided by states before the stimulus, it was usually just $400 a week, which, as we know, really isn't enough to get people through this. So the CARES Act has provided a federal benefit of an additional $600 a week on top of what you would normally get from the state. And it's also tacked on an additional 4 months worth of the benefit on top of what you would have normally gotten through the state. So they really are trying to help these folks who have been impacted and aren't able to work. And they've also expanded who's eligible for these benefits. So before this happened, most independent contractors, if you were self-employed, you generally weren't eligible for unemployment, but they have expanded it. So those folks who are independent contractors, they're 1099, they're self-employed, or maybe they have a limited work history, these people are now eligible for unemployment. So they should definitely reach out to the unemployment office website for details. And just a note, you can apply online. A lot of states are having issues with their online platform. They're not built for this many claims. So we are seeing that they are trying to come out with solutions. Just today, I saw that they came out with a mobile app for unemployment in Florida. You can print out the application and mail it in. As difficult as it is to get the claim in, we do encourage you to keep trying. We do want to make sure that anybody who is eligible for this benefit is taking advantage of it. You are entitled to it. So we definitely want to make sure you try and receive this.
Thank you for that, Yesenia. And as we're thinking about changes in our income coming in, if that is what happens, then we may need to make some adjustments. And we often have these conversations with our clients. If you don't know where your money is going, definitely now is the time to know, because you could begin to make some changes. I think the current situation has forced us into making some adjustments into our discretionary spending at the very least, and maybe now we have had a chance to reevaluate what's really important as far as spending is concerned. Maybe we're stretching out a little bit more of those groceries because we don't want to go to the grocery store as often and so forth. So the basic message here is to revisit that cash flow plan. It really is the foundation for many, many decisions in your financial planning house. And there are tools available to you to begin pulling this together. We give our clients a spreadsheet to use that's easily accessible. If you want it, we could give it to you after the webinar. We also talked about mint.com as being a digital platform to aggregate all your data and to track any type of expenses from your credit cards and so forth, to make it easy to see everything in one dashboard. One of the things that we look at when we have to cut back expenses, if that's necessary because you have to deviate from your current plan, is even looking at little tiny adjustments. Something as low as 3% is sufficient to make a significant change in expenses, or even adjusting the withdrawals that you're taking from your retirement plan. If you're, for example, taking monthly distributions and you realize that you're taking more than you really need, then you might want to adjust it a little bit. You realize now that you can make those changes. We don't encourage people to make big changes drastically, because it's like going on a diet, right? Nobody likes that. Nobody likes to be told they can't do something. But I think this is a good time to revisit what's most important to you and look at those key things that can make a difference. And even having someone else look at it, either your partner, your spouse, or have us take a look and make some suggestions so that you could be more efficient with the dollars coming in and out of your household each month.
And Kat, I'd actually like to add something. When
Oh,
you
okay.
were speaking now, I was just thinking, how
Let me go
many
back.
automatic payments do we have coming out of our bank accounts that we're not using anymore because we're stuck at home? I'm thinking of gym memberships. I know personally I had an Audible membership because when I was driving in the car, I'd listen to audiobooks. I'm not using that anymore. So I'm just thinking of all of these automatic payments we don't even think about. We're not enjoying them. We're not getting any value. So maybe evaluating those and just cutting it for now while we're not using them.
Yeah, that's so smart. Thanks for sharing that. And I'll put in my shameless plug of using the free library Audible. I love that application. All right, so going on to what is the game plan, right? So if we do have to make some changes, where will we dip into to make sure that we have the monthly income to meet our expenses? And we say often that we're always planning for the worst case scenario. When we have our clients in front of us, and we talk about buckets, what are those buckets that are serving different objectives? We have this conversation often. And the first one, we talk about emergency funds, right? Leaving those funds on the sidelines, and they're not that exciting because they're not doing a lot. Some of them are sitting in a high yield savings account. But they're really exciting right now because they create peace of mind, knowing that that could be the first bucket that you could go to help offset any changes in income coming in. The other bucket that we look at is those brokerage accounts, right? Those individual or joint investment accounts that could be liquidated very quickly, right? So if you need funds from there, we could easily transfer those funds to your account as needed. But knowing that that other layer of safety net is available to you is key, especially in these times. Again, creating a plan to reduce anxiety. That third bucket is a big bucket, and I'm going to go into it a little bit more because it does impact your taxes a little bit. But the legislature talked about giving you access to additional distributions from your retirement accounts. And these include obviously your IRAs, Roth IRAs, 401ks, 403bs, 457s, etc. And they're saying that you are able to take an additional distribution up to $100,000. And that's big. If you don't have an emergency fund, if you don't have a taxable joint or individual account, this might be that third bucket that you might need to access, right? If you are taking those distributions, they have to be related to the COVID-19 that's been written in there, and they must be made in 2020. Now, key thing here, when you're taking those funds out, normally, if you're under the age of 59 and a half, you would receive or you would be hit with a 10% penalty. So they're waiving this. They're saying, we're not going to penalize you. If you really need the funds, we're going to make them accessible to you with no penalty. But there is a taxable event that happens there. So we have to think strategically and see if we could space these out depending on what's happening, as opposed to taking it all in one lump sum. In addition to that, if you have an employer plan, a 401k, a 403b, then you are able to max out the loan out of there if you needed to take funds immediately. So before it was 50,000, now you could max it out to $100,000. Anything that you have vested in there is obviously accessible to you. And if you are in paying it back, if you have to be separated from service, they have extended that payment plan by 1 year. So this is actually something that really needs to be thought out strategically with your financial planner. You have to go back and look at cash flow so that you could really assess what is the impact of paying these funds back, what are you using them for, and so forth, because we want to make sure that with every decision, we maximize that tax efficiency of the strategies that we present before you. Now, I'm sure you've all been asked and you're very curious and you're probably looking at your bank account every day to see if you received a stimulus check, if indeed you were within those adjusted gross income levels. We don't know. We don't know when they're coming out, but we do know that they're coming at some point. And our understanding is that they're going to give it to those who have banking instructions already set up with the IRS because of their taxes that they filed in the past, or they're going to be sending a check in the mail. When we look at who qualify for this, the first table on the top will show you if you filed individually in 2018, or if you already filed for 2019, then they're looking at adjusted gross income of $75,000, and the benefit is $1,200. For those of you filing jointly, it's $150,000 with a benefit of $2,400. Head of household, the benefit would be $2,400 for those to have an adjusted gross income under $112,500. And then for children under the age of 17, it would be $500 per child. Now, there is a phase out for this, and they have put in place that thresholds are going to be reduced $5 for every $100 above the threshold. So in this example below with George and Martha, for their children ages 12 and 14, they would get $500. That would be a recovery rebate of $3,400 because it includes their recovery rebate as well. But then the phase out at the bottom shows you how it would cut it back just a tad to $2,400 for this year. Now, this is not something that everybody's excited about, that they're going to be phased out, but the good news is that if, the good news and bad news, if you had to reduce your income in 2020, then when you file your taxes in 2021 for 2020, you're going to get a refundable tax credit as long as you're within the phase out limits. So again, this is something to discuss with your financial advisor, with your CPA, to see where you are. I just want to throw this out there because we do talk a lot about charity. That's something that we feel very strongly in our firm. If we're able to help others, that's a value that we have as an organization. If you do get the stimulus check and you happen to be one of the fortunate people that don't need it, think about what charity you might want to give some to. That's another way to spend those dollars.
And Kat, actually, if you don't mind going back, I did want to add something
Sure.
to it. So those people who, based on their 18 or 19 return, depending on which one is used, which one has been filed most recently, if you are eligible for the stimulus check this year, but maybe your income was high in 2020 and you wouldn't have been, there isn't a clawback. So they're not going to make you pay it back if you, based on the 2020 return, you fall out of it. So it is the best of both worlds. Those who aren't eligible now but will be based off of 2020 will get the stimulus check. But on the opposite end, if you're eligible today but wouldn't have been based on 2020, they're not going to ask for it back.
Yeah, that's great. So thank you for pointing that out, Yesenia.
Of course. I know there's a lot going on with the stimulus checks, and everybody wants to know all the ins and outs of them. So then going to something that has been talked about much less, a lot of people haven't really been thinking about too much with the schools closing, even though I'm sure they've noticed a college student at their house now when they weren't expecting them. But because of all these schools closing down, maybe some of them haven't continued doing online courses. Some of them are actually refunding the unused portion of tuition. And that's generally a good thing. You're not paying for tuition that you're not using. However, there is a big caveat. If you use 529 plan dollars to pay for that tuition and it gets refunded, it could potentially be subject to taxes, income taxes on the earnings from the 529, and potentially a penalty because it's no longer being used for an eligible education expense. And there's going to be a complicated calculation that goes out to try and figure out what's the tax going to be, what is the penalty going to be based on what's been used, what hasn't been used. I'm sure it's going to be very complicated, but there is an easy fix to it. So if you are one of these folks who paid for tuition using the 529 and you get a refund, the best thing and the easiest thing to do is going to be to put it back in the 529 within 60 days of receipt and treat it as a rollover. So if you just put it back in the 529 within 60 days, you're going to have no taxes, no penalties. It'll be like nothing happened. So that's really something to look out for anyone who gets a tuition refund in the next few months. You have 60 days. Otherwise, it'll be very complicated.
Thanks for the tip, Yesenia. I'll be sure to tell my brother about that one with my nephew being home from college.
I'm sure he's so excited.
Oh, he's so thrilled. Anyway. All right. So one of the other provisions that we see is a suspension to the student loan payments. And this is big, because it's going to give you the ability to wait until September 30th to begin repaying your student loans. Maybe you don't have a student loan, but you have a child that has a student loan that is working, and this could really help them if their financial situation has changed. Or, another family member. The key thing here is that interest is not going to accrue during this suspension, so that is huge. And for those who have loans or participate in that public service loan forgiveness, especially if this is for individuals who are working for nonprofits, the suspension period will count towards the forgiveness. So this is huge, huge, huge. So essentially, if you work for a nonprofit and you're still employed and you have the funds to pay, a strategy could be to stop making those payments because the suspension is going to count towards the forgiveness, and maybe set those funds aside for an emergency fund. There's a strategy you could implement. For those who are in the income-based repayment program, the suspended payments also are counted towards the forgiveness. So this is a big deal again. And most importantly, that suspension is going to reflect as if they made payments towards their student loans under credit reports. And this is key. We talk about credit being your financial report card, especially for the young adults, navigating their financial life. It's key that they stay up to date with their credit reports and what it says. So this is a really nice provision to help them out. The last one is that employers can help offset student loan payments to a maximum of $5,250. We often help our clients review their employer benefits, employee benefits, and what they can do with that to maximize their paycheck, because it's not just what they get paid, but what are some of the other benefits that they have access to. This is something that I would ask my employer, would they be willing to do this, right? So encourage those people in your life who have student loans to approach their HR department, to approach their employer and see if this is something that is accessible to them.
Excellent. And then, so I know everyone's kind of talked about student loans, and this next item that I'm going to talk about isn't really new. It's not coming up as a result of COVID-19, but it's definitely an opportunity given the circumstances. So generally speaking, the best use of retirement accounts are for their intended purpose, which is retirement. But because of everything that's going on, there might be a lot of people facing cash flow issues, and maybe they don't have that emergency fund or a taxable account that they could dip into. Maybe they have to dip into retirement accounts to make ends meet. For those people, there might be an option to look into. A rarely discussed planning strategy, which is actually really helpful right now, is called a qualified health saving account funding distribution. So I know that was really long. A qualified HSA funding distribution. So this is a once in a lifetime option to fund your HSA with funds from your IRA. Now, it's not once in a lifetime because you have to do it now in 2020. They literally only let you do this once in your life. So you could do it this year, you could do it next year. Doesn't matter when you do it, but you can only do it once. But this year might be a good opportunity to do it because of the low cash flow that a lot of people might be facing. So what this does, it essentially converts pre-tax dollars into potentially tax-free without having to pay any tax. So the way this works if you have a health savings account, let's say you have a high deductible health plan, you're eligible, you have an HSA, and you've been using it for medical expenses, typically you fund that every year. And I have the limits here on the slide for individuals or those with family coverage. Let's say you need a little bit more this year. You know for a fact that you're going to have some health bills you want to pay, and you have nothing in your HSA, so you have to dip into your traditional IRA. So yes, the CARES Act did waive the 10% penalty, but as Kat mentioned before, it's still subject to income tax. Something that you can do is just take the funds in your traditional IRA, put them in your HSA. Now keep in mind, this is not a taxable event. You're taking pre-tax and putting it in an HSA, which is tax deferred. There's no tax paid on that. And then if you use the funds in the HSA for medical expenses, now you don't have to pay income tax on it. So just depending on where you pull the funds from for medical expenses could greatly impact your taxes. So there's really a way to do this in a tax efficient manner just by pulling funds from your traditional IRA and putting them in your HSA. And it also solves the cash flow problem because you don't have to take it from savings. So this is a really nice opportunity that we could think about doing this year. Again, speak with your advisor about this and see if this makes sense. And of course, this is only for those who are eligible for an HSA. Not everyone can have one. You have to have a high deductible HSA eligible health insurance plan. All right. And now I know we've spent a lot of strategies. We've been talking a lot about helping those who are facing challenging times, whether it's a lack of cash flow, maybe they don't have the savings. But on the flip side, we've actually seen some clients who see the opportunity presented by the market volatility. Maybe they've just received bonuses. They're not really that concerned with cash flow. Maybe they even have excess cash built up above their 3 to 6 month emergency fund, and they really just want to put it to work. Now, for those people, this is really an excellent time to put those funds to work. And there's several ways that you can do it to most efficiently take advantage of the market volatility that's going on today. So if you find yourself with excess cash, we don't know what to do with it, what a great position to be in, you can consider bundling your 2019 and 2020 IRA or Roth IRA contributions now. Instead of waiting to do it next year for 2020, just do both of them now. You could essentially get $12,000 now into your IRA and really take advantage of the fact that the market is in a pullback right now and is volatile. Or you can also contribute to your HSA for 2019 and 2020 if you're eligible. That's also an option. We like to recommend the tax-free vehicles first, so HSA, Roth IRA. But even if it's an IRA, we still recommend putting that cash to work in one of these retirement vehicles. Now, let's say you don't necessarily want to put it in your IRA or an HSA. Maybe you just want to increase your 401k contributions. So that's something that you can do as well. There are some people who maximize through all 26 paychecks if they're paid bi-weekly, and every 2 weeks they contribute to the 401k. We have seen some folks who are just putting their entire paycheck into the 401k right now because they have excess cash on the sidelines to live off of. So that's also a strategy that you can consider depending on your situation. Or let's say you've done all these things. You had enough cash to front load your IRAs, to do your HSAs, to maximize your 401k, and you still have cash. What an awesome problem to have. Maybe you could consider dollar cost averaging into your portfolio. So at that point, you take, let's say it's an extra $10,000 that you have that you want to put into your taxable account. You can do it over time. Take advantage of the fact that the markets are volatile, they're moving a lot. And instead of going into the market all at once on one day, do it over a few weeks or maybe a few months. So we do have opportunity here. And if you do find yourself with this extra cash, we do recommend that you speak to us to see about what's the best way to put this to work right now.
Yeah, and as we're looking at different opportunities from a cash flow perspective and money that's coming in, Yesenia, thank you for pointing that out because we got to look at the bright side, right?
Of course.
Another thing that has been coming up during these times, and I'm thinking some of our clients have thought about this. I know because I've actually had some clients reach out to me and ask me about this, but estate planning, and this might be just the wake up call that we all need to make sure that our estate plan is good to go, because this is the type of emergency where you would deploy your healthcare proxies and all of the things that come into the financial plan from estate planning perspective. So one of the things with the healthcare proxies that some clients may have encountered is that they have somebody that could make healthcare decisions for them, but maybe that person is not here in the state. And obviously, with all of that's happening with travel restrictions, how viable is that? And just thinking about maybe a backup person that could step into your shoes and help you if they had to come in, so really rethinking that a little bit. Living wills, this is extremely important. Would you be able to, if you're in a situation where you cannot, you don't want to be kept alive, is this something that you would still consider, being that this could be a possibility right now? Maybe you change your mind. Maybe you're somebody that was felt really strongly about this, and now you had a second, maybe some more reflection and change your mind. These documents can be changed. HIPAA authorizations. This is an important document to make sure that your loved ones have access to your health information. Do the right people have it? Maybe you want to have a key person in your family as the go-to person to gather all the health data, all the health information, and disseminate it within your family members. So this is a good time to see who is the person that would navigate this type of situation really well. Power of attorney for finances. Yesenia mentioned earlier that maybe a lot of us already have things on automatic payment from our bank accounts, and that makes it really easy. If something happens, bills are still going to be paid. But I would say it's really helpful to have somebody that could step into your shoes and make other decisions if needed. Stop payments or make payments, or just be able to step into your shoes from a financial perspective. That's incredibly important. And something that I have talked to some of our clients during this time is updating their beneficiary designations, from retirement plans to investment accounts to life insurance policies. This is extremely important, just gauging like who is going to be the person that received these assets. Do they know? Do you want them to know? Are documents easily accessible? I mean, that's something that we talk about, putting them on the cloud so that anybody anywhere, especially now, will be able to access that information without being limited by travel. So this is a good time to reevaluate that part of your financial plan. And of course, our clients know that we are more than happy to quarterback these conversations with their estate planning attorneys to make sure that their wishes are clearly outlined and put into play. And as we get down to like towards the end of our webinar today, one of the things that is really important is to keep the pulse on your financial plan. No doubt this has felt like a roller coaster. I know that we're not immune, even as financial advisors. We have feelings and and we get anxious as well. But what's really helpful is to have a plan and to revisit that plan, either from, are my investments on track? Is my retirement projection on track? What are the other things that are going to create that safety net and provide the peace that I need to feel good, about my financial house? And that's what we're here for. If you need to tweak anything, we're happy to talk to you about that. Maybe it's just the tweak that you think you need to make may be smaller than you actually see it in your mind. I know and I know we've had, Yesenia, you and I have had several client meetings where we revisit your projections, and clients are just relieved to have that conversation. And that's what we're here for, because it is through talking through this and walking through the what ifs that we could reduce the anxiety around what's happening right now. So that's what we're here for. We're only a phone call away, an email away, a webinar away. So make sure that you reach out to us because we're here to assist you. And most importantly, your health is your wealth. And if we could help create a plan that's going to reduce stress, that means that your immune system is going to be stronger, your heart is going to be stronger. This is not the time that you want to get sick, obviously. So if we could help offset that through creating a solid financial plan that will give you peace, that's what we want to do. And this is also a good time for you to reflect on how money aligns with your values. We talk a lot about money being a tool, right? It's a tool to help us achieve things in life. And what are those things that we're trying to achieve? So if you're reflecting on that, if you want to talk it through, we're here to help you talk it through because money is intended to solve problems. So we want to help clarify that for you.
Absolutely. And also, as a next step, keep in mind that you're not alone through this. I know that it feels like we're alone. We can't go say hi to our neighbor, or we have to do it from afar with a mask on. We can't go see our loved ones. And I know, especially during holidays, birthdays, it's very challenging. It's very difficult. We feel alone, isolated in our homes. But this has never been a better time to be so connected. The fact that we could have a webinar from each of our homes, we can work remotely. We are here for you. We can be connected. So even if we're not physically in front of each other, keep in mind that we are here. So don't feel afraid to just give us a phone call and talk to us about how it is that you're feeling. I know it is a difficult time for a lot of us. So we're here to be a sounding board and revisit that plan. Something that we want to remind you is that whether we looked at your plan a year ago, a few years ago, or just recently, this is a time that we take into consideration. We didn't know it would look like this, but we knew that there would be some curveball. So we have been planning for something like this, and it's helpful to revisit it and see that maybe it didn't really impact your plan that much, not as much as you thought, like Kat was saying. So just remember that you're not alone. Know that you have a professional team here to help you through times like these, and reach out to us. Don't be afraid to give us a call.
So we want to open it up for questions and comments, and we already had somebody put in the chat, Yesenia. Mm-hmm. They liked our first graphic with the dollar bill with the mask. Thank you very much.
It is an excellent graphic, Kat.
All right. One of the questions in the chat, Yesenia, was are college students going to get the stimulus check? Can you talk a little bit about that? Mm-hmm.
Yes. I definitely have been hearing this question a lot. I've even had kids of clients reaching out to us directly because they've heard about this, even if they haven't been as involved with their finances. So the answer to that question, are college students going to get the stimulus check? Unfortunately, most of them probably won't. Generally speaking, college students are claimed as dependents by their parents. And that's not all students. Some students make enough funds, they support themselves, and they can claim themselves. But if you are claimed as a dependent, then you will not receive a stimulus check, and your parents will not receive the $500 extra for children because they're most likely 17 years of age or older. Now, if they did have enough income and filed their own tax return for income that they earned, then, and they claim themselves, that's important, then they might be eligible for it. Now, if they didn't file on their own in 18 or 19, there is potentially an opportunity to claim themselves in 2020, but we wouldn't want you to just go and claim yourself. There are rules around who is eligible to do so. So we do recommend talking to us, talking to your CPA to see if your child is eligible to potentially claim themselves in 2020, because then when they file their 2020 return next year, they would then receive the stimulus check as a credit.
Thank you, Yesenia. We had another question of a topic we haven't really touched on here
Hmm.
related to refinancing your homes due to the reduced interest rates. Um, we know that the rates have gone down and we have been monitoring this because it does provide a good opportunity for those of you who want to either reduce the term of your loan and take advantage of lower rates and so forth. We analyze this on a case by case basis, especially in light of any other debts that you might have. And some of you may already be doing your own reduced amortization schedule, so just keeping in mind that this is a very personal decision. We have to look at it on a case by case basis. We haven't seen a significant drop in rates that have been passed down to the consumers just yet, but we are excited when it does happen. We'll be excited and we'll be able to talk to those of you who have mortgages that want to jump on that opportunity. Um, Another question that came in that we already answered, I believe, during the webinar, Jasenia, was when
Hmm.
do we get the stimulus checks?
Yes. Hopefully soon. They were supposed to start trying this week. I'm not sure that people have necessarily started getting them. But I would say over the next few weeks, people who have already entered their bank account information either in their 18 or 19 return, they'll probably get those first, with the remainder of people getting paper checks in the mail. Those will probably come in, I would say, in the next few weeks, maybe to a month out. But the timing is still unclear. We're still looking at bank accounts and hoping those come through sooner rather
Absolutely.
than later.
Yes, yes. So it's time for us to wrap up the webinar. If any of you have any additional questions or if we didn't have a chance to get to your question, we will be sure to pass this along to your financial advisor so they could reply to you directly. And we want to thank you all again so much for spending this time with us. We know your time is very valuable, and we hope that we brought some clarity around financial planning moves due to the CARES Act. Take care, everybody. Bye-bye.
Thank you. Take care. Bye bye.